Hello and welcome. Today's training topic is on cash flow. Cash flow is the absolute foundation piece of all business. Without good cash flow, businesses quickly start to struggle. Cash flow can be thought of as the blood in your business or the oil in your machine that is your business. So cash flow can be negative as well as positive. So what do we mean by negative cash flow? Negative cash flow is when there's more cash flowing out of the business than in. This is where businesses begin to struggle. Positive cash flow is the opposite. It's when there's more cash coming into the business than leaving. So it's a foundation piece of all business, as I've just said. And when a business is in infancy, and to look at the stages of business, have a look at one of the previous training sessions that we've done. Cash flow is an absolute priority. In fact, it's the most important thing that a business in infancy needs to tackle. So normally, to increase cash flow in a business, you need to increase the sales or the number of sales or the sales value. And these are things that you need to focus on when you're in infancy. When a business moves into adolescence, cash flow is still very, very important. However, the secret here is to create a predictable cash flow. So this is where your order and your systems come into place. This is where your marketing needs to produce a consistent number of leads, which you then need to convert into sales in a consistent and regular manner. That is the secret of order within adolescence in terms of your cash flow. When a business enters maturity, cash flow is the security piece for the business. It enables the business to invest, to have an impact. It makes the business more attractive if you want to sell it, if you have a positive, regular cash flow. Now, all businesses can struggle with cash flow if there's unexpected costs occurred. And this is what we tend to look at from a business point of view as what we call the cash flow cycle. Now, the cash flow cycle is basically how cash is used in the business. So there's a certain amount of cash at the beginning of a reporting period, and that cash is then used in a number of ways. It can be used to pay creditors. It can be used to purchase goods, which will then be hopefully sold further on into the period, or it can be used to purchase assets. So cash comes in, cash is used in a number of ways. Like I say, it can be used to purchase parts in a garage, which are then fitted to a vehicle, which are then hopefully sold. And then once the sale takes place, we have to collect the money, which then turns back into cash. Now, if we're doing the job well, at the end of the cash flow cycle, there should be more cash coming back into the business than left. Now, the problem here becomes with timing. Now, depending on the type of business that you run, you may have jobs that take longer to complete than it is on the current cash flow cycle. Therefore, you'll have an outlay for parts that you've already paid for that you may not have been paid back in the reporting period that the cash flow cycle is in. So that's when businesses start to struggle, when there's more cash leaving the business in the purchasing part of the cycle than there is coming in the sales and collection part of the cycle, which is difficult to manage, especially for a business in infancy. So a business in adolescence, hopefully, has systems in place, which means the cash that's leaving the business is always being replaced by the cash that's coming in by predictable, repeatable sales, which is the key thing in adolescence, is to create that for the cash flow cycle. Now, a business in maturity can still run into trouble with cash flow, especially if it starts looking at spending on sort of big asset purchases. It could be something simple like fitting in an MOT bay. The MOT bay cost has to be paid for. Therefore, if you purchase in the capital equipment that is the MOT bay, and you've done it on a lease agreement, that money goes out every month, whether or not you do any MOTs. So cash flow has this importance that always needs to be looked at. And the way we manage the cash flow is something called a cash flow statement. Now, depending on your finance setup and your accounting packages or your garage management systems, you may not have a ready-made cash flow statement. So an easy way to build a cash flow statement for any kind of business is simply set up an Excel spreadsheet and record the money's coming in and the money's going out over any period. Now, the period is up to you. A sensible period can be every month, but you can also look at it weekly, or you can even look at it daily if you need to. And what you need to do is you need to look at how you're using the money in the business. So how money comes in, how that money then is spent. Like I say, that can be paying loans, purchasing parts, or assets, equipment, etc. Now, that's how the money is used in the business. And then you're going to look at how your sales take place and how you collect the money. And that's the basic essence, if you like, of the cash flow statement. And all you're doing is you're recording them every time the cash comes into the business. You write it down in the spreadsheet in one column, and every time money leaves the business, you write that in the next column. What happens then is you build up a profile of how the business uses that money, and you can look at whether or not your money is being spent mainly in purchases in terms of parts. You can look at whether or not there are assets continuously being purchased by the business, and you'll see how the business uses the cash. So a business in infancy is probably not so worried about asset purchase as it is how it's buying its parts, when the parts bills go out, when the cash comes back in for those parts, and how effective you are at moving the cash from a purchase back into a sale. And that's the essence of your cash flow statement, is you're able to look at that in a way that makes the movement of cash through the business more predictable, so that you're always having a surplus of cash. That's the idea. And the cash flow statement is where you manage that. So we said, how can you increase cash flow in a business? Well, the simplest way to increase cash flow in a business is to do more sales. Now, that's easier said than done, but that should be a target of the business, is to increase sales. If you can't increase the number of sales, you're operating at maximum capacity, then you need to increase the value of each sale. Now, another really useful way of increasing or making your cash flow positive is to reduce costs. This is often overlooked by businesses because it's something that's a little bit mundane. It's not very sexy. However, if you look at your cash flow statement, you can have a look at where you're spending your money. You can find a way of reducing costs. And one interesting way of doing it is to look at the total costs for the business and then look at reducing costs by a percentage. And there are many ways of doing this, and we'll look at that in another training session. So what happens if a business ends up in negative cash flow? Now, business in infancy normally find it difficult because of the increased startup costs and the fact that they probably haven't got many members of staff. There's a finite amount of work that can be done by the if it's a sole trader, the one person in the business, normally the business owner, or if you've got just a couple of members of staff, it's very difficult to do more work. So it's very, very difficult then to do more sales. Therefore, you can quickly find yourself in a negative cash flow situation. And what normally happens when you find yourself in that position is the first thing that happens is the business owner doesn't pay himself. Tries to pay all the other bills, tries to pay any staff, certainly first. And what happens then is you end up in a position where you can find yourself the lowest paid person in the business. And what we call this is when this is the same as having a job, JOB, which stands for just over broke. And that is where most small businesses start to fail, is when the business owner starts to lose motivation because he's not being remunerated for his work or her work, because the cash flow situation is slightly too negative to sustain. Now, most small businesses struggle with cash flow at some point, and therefore another good tip for helping with a negative cash flow situation that's temporary rather than a permanent cash flow situation is having a reserve. Now, in the COVID pandemic, easy for me saying, pandemic recently, lots and lots of business had to borrow money from the government or relied on handouts from the government to get over the period where they weren't able to trade. Now, the lesson that taught me more than anything else was you must have a small amount of cash reserve in the business. Now, COVID probably a unique situation, but how can you say that we're never going to have another one that or something else like that? Any period where you can't trade, therefore you can't bring in cash, you need to be able to get over that hump. So what I took from COVID was you need to have a minimum of 3 months cash reserve in the bank. Without that cash reserve, what could quickly happen if we have a unpredicted situation? It could be an illness, it could be another sort of national emergency where you're no longer able to trade. Your business could quickly run out of cash. So big tip for cash flow is to steadily build up a cash reserve. Once you've got around about from my experience with COVID, I'm suggesting around about 3 months of operating capital. So how much if you do your cash flow statement, you'll get an average cash flow out of the business every month, or look at your operating costs. What you really want is to be able to have in the bank or in a savings account somewhere 3 months reserve capital. So what you would normally spend in a month, 3 months worth of that sat there for an emergency. So there's one way of dealing with a potential cash flow situation. So when I started doing all the research and looked at how I could improve the situation in my business, the big thing we looked at was how much we charged. So it wasn't that we were going to be able to do lots more work. So we couldn't do many more sales, though we have increased sales. That is a definite aim for increasing cash flow. What we did is we increased the average sales value. Now, there are many, many ways of doing this, and we'll look at this in the future training, but that is the key to improving cash flow. It's either increase the number of sales, which isn't always that easy, but you can easily increase your sales value. You can add the McDonald's method was, do you want fries with that, sir? You've got to find your fries. And what is it you can add to every sale? And it's not about taking advantage of customers, it's offering more value. And we'll talk about value creation in another topic as well. And like I've already mentioned it before, but the third thing to do to increase cash flow is to reduce your costs. Now, one of the major exercises we went through last year or the year before that, when COVID started, we looked at everywhere we could trim even more fat off already a lean operating business. And we found that there is always something that you can remove from your business that doesn't affect value. And not suggesting penny pinching here where you take away stuff that makes your business better than someone else's. They're not the things to cut. The things to cut are the things that don't really add much, that you're paying for, that you kind of don't use. And if you look carefully, there's always something that you can trim away. So they're the 3 things that I recommend four things any business does to ensure that they get over any cash flow issues. The first is increase the number of sales. Second, increase your sales value. That's probably the one that you can focus on the most. Reduce costs and save 3 months operating capital. Thanks for listening. If you've got any questions, I'll take them now.